Our first case study is an architectural firm. Now this is an actual valuation that we did earlier this year. And while this architectural firm had been very profitable in years past, architectural industry was one of the hardest hit by the downturn in the economic crisis. And so in the most previous years, 2010 and 2011, after paying their owner a fair wage, there was zero cash flow left over. So under the formula, cash flow times multiple, we get zero value. Under the income approach, this architectural firm has a zero value. In our second case study, we have an IT company. Again, an actual valuation that we did earlier this year, where the IT company actually has a normalized cash flow of $1 million. We go about the process of developing the cap rate, and it came up, I think it was 19.6% or something. We're going to round it off to 20 for illustrations here. So we've got a 20% cap rate, which is a 5 multiple. We take the 5 multiple times the 1 million of free cash flow, and we get an income approach value of $5 million. So we'll come back to these case studies after we've calculated the second approach to value, which is the asset approach. Here in the asset approach, what we do is we add up the value of each asset separately. And it's the market value, not the book value, those assets that count. So what can we resell each of these assets for separately in the marketplace? What you're going to find is that the asset approach is most useful in liquidations. And I'll explain that to you at the end of this slide. What we do is we're looking at the value of the office equipment, the furniture, the machinery, and any other assets that the company has. We go through and we look for a ready third market for each of those values. Now, as you can imagine, a lot of the assets that you have will have a relatively minor value. Say, for instance, a computer. You buy a computer, and the first day you put it in your business and you start working on it, what is the resale value? And where are you going to resell that? If you put that out on Craigslist, how much money would you get for it? We know it would be nominal compared to what you paid for it. And so most of the minor assets in your business are not important when it comes to the asset approach. They have very nominal or minimal zero. It may even cost you as much as you'll get in order to dispose of those assets. But significant equipment, say for instance, we did a valuation for a spinal doctor, and he had a MRI machine that was specific for doing x-rays of backs, of a person's back. And when we went out to market, we were able to readily identify very similar equipment in the marketplace for sale for significant values. The most significant values are the only ones that are really going to be considered. The nominal values will probably use some sort of small estimate, 50% of book value or 50% of cost, 20% of cost, something along those lines. But one of the key points with the asset approach is to understand that it's the total value of the assets resale value in the marketplace. And what I think you'll be interested to learn is that the income value minus the asset value actually equals your blue sky. Everybody likes to learn what blue sky is all about. And that's your goal in a business, is to create value beyond the value of the assets that you purchase. So if you can go out and assemble a bunch of assets, put them to use in a business, and create an income value that's in excess of the asset value, then you've actually created equity and created value in your business. So look at our example here. All of the assets in this business total up to $1.3 million. The income value, $5 million, minus the asset value of $1.3 million equals blue sky of $3.7 million. So if you were buying this business, you'd be buying $1.3 million of resellable assets plus $3.7 million of goodwill. Again, the goodwill being represented by the amount that the income approach exceeds the asset approach. So let's go back to our case studies and let's look at the architectural firm. We went through their balance sheet, we looked at all their assets, liabilities, etc., and we came up with an asset approach value of $100,000. Moving on to our IT company, we went through their balance sheet, looked at all their assets, market values, etc., and came up with an asset approach value of $1.3 million. So I'd like to move on to our third approach to value, which is the market approach to value, and then we'll come back again to our case studies and show you how each of the three approaches to value stack up with respect to each of these companies. Under the market approach, we develop a value based on sales transactions of similar companies. Here's the search results from a common database that we use. This example happens to be automotive repair and maintenance services. And what this tells us is, when you see MVIC divided by sales, what that tells us is sales price divided by sales is 0.4, or 40%. So in other words, if you had a business that was an automotive and repair shop, and you had $1 million of sales, we would multiply your $1 million in sales by 40%, which is the average sales price in the marketplace that similar companies sold for, and we would get a $400,000 value. $1 million in sales times 40%, $400,000 value on the market approach. Now I kind of call that a rule of thumb, because you'll hear a lot of people talk about, oh, I've heard that my insurance business sells for 100% of gross sales, or I've heard that my architectural business sells for 60% of gross sales. You know, these market multiples are actually very accurate when it comes to middle market companies or bigger companies. But there are a variety of reasons why these sorts of rule of thumb are not very good for smaller companies. Let's take a look. I use these market transactions mostly as a reasonableness check, because with small companies, accounting methods vary substantially. You've got most small businesses keeping accounting records to file tax returns. And on a tax return, a company, the very same company that's a sole proprietor versus a corporation or a partnership, will have a substantially different looking bottom line, different looking accounting records. Whereas if they're a very large company, publicly traded, middle market company, they will have accounting people on staff that keep financial statements for generally accepted accounting principles. And those sorts of, and a financial statement done under generally accepted accounting principles is comparable from one company to the next, regardless of the tax basis of accounting or accounting method that they use for taxes. Ask yourself this question: in your small business, do you keep your records for generally accepted accounting principles, or do you keep your financial records because you need to file taxes? Most people keep them because they need to file taxes. And because the accounting methods are so different, lots of the market transaction data is not comparable. You don't know what you're comparing yourself to. Some other reasons are there are few comparable company transactions, the location of the comparables matters, and the uniqueness of the business or product is also difficult sometimes to find comparable transactions. In fact, we just did a business valuation for a company and we found 28 comparable transactions, sounds like a lot, over a 10-year period in 27 different states. And so when you drill down on it and you take a look, it's just not really all that comparable. It's not very reliable information. So the data reported is not that credible. Again, it goes back to the source, which is the accounting records, which are the tax returns, which are put into these databases, and they're all commingled, so they're not so comparable. So we look at market transaction data as simply a rule of thumb, giving us a hint as to approximately what kind of value we should see. Let's go back to our case studies and let's look at the architectural firm, and we'll calculate the market approach value. The architectural firm was projected to have $760,000 in sales. The market transaction data told us that architectural firms sell for about 60% of value. So under the market approach, we get a value of $456,000. Now let's go to the IT company. The IT company was projected to have sales of $8 million. The IT company also showed a market transaction comparable 60% of sales. When we multiply the 60% times the $8 million, we get a value of $4.8 million under the market approach for the IT company. Now let's summarize each of our case studies. First, the architectural firm. If you'll remember, under the income approach, the architectural firm had a zero value. Under the asset approach, the architectural firm had a $100,000 value. And under the market approach, the architectural firm had a value of $456,000. So when we issued our report as valuation analysts, what value was given on this business? The answer is $100,000 for the asset approach. Now, if you sold this business for the market approach value of $455,000, you would likely get it back, because the new buyer needs to rely on the cash flow from that business to service the debt or the money, the investment that he made to buy it. And with the income approach being zero, there won't be any money to service that debt. Now, you've heard of a lot of people who sell their businesses on contract and get them back in a big mess. This is how it happens. They relied on a market approach transaction. The income didn't support that, and therefore the transaction was doomed for failure from the beginning. The asset approach here is a liquidation value. Now, I'm going to propose to you that if you're getting a liquidation value, you're probably not one of the 2%. If you recall, liquidation is one of the reasons for the 98% of failures. If you want to create wealth in your business, the income approach to value has got to exceed the asset approach to value. Let's go on to the IT company. In the IT company's case, if you'll recall, the income approach, we gave a value of $5 million. The asset approach, we gave a value of $1.3 million. And under the market approach, we gave a value of $4.8 million. So what approach did we use or rely on, and what value did we give it in our report? $5 million under the income approach. The income approach is the most credible source of value. It's the one that the 2% Club focus on. So I'd like to recap this section by just telling you that the critical drivers of value are cash flow and multiple. We can see how market data is not that reliable. We can see that asset approach is a liquidation value, and we can see that the way to create wealth in your business is to improve the cash flow. When you sell a business, what you're selling is the cash flow stream. It's the return on investment that the buyer is buying. In order to make your best business value, in order to make your business the most saleable for the strongest value, focus on your cash flow. Thank you.